Investing is all about strategy, and with the right one, you can multiply your money and build generational wealth. Today, I'll be giving you 7 ways to invest $1,000, whether it's your first $1,000 or your next $1,000. And this video is beginner friendly, so don't worry if you're new to the investing world. I'll break everything down for you, so let's get started. The first strategy is to invest in individual stocks. With this strategy, you would research individual companies that you're interested in and then purchase shares. And if you're someone who's interested in investing in high dividend paying stocks, then this is an option that you may want to consider. If you're not familiar with dividends, basically profitable public companies can pay out a portion of their profits to shareholders in the form of regular dividend payments. And there is nothing required on your end other than just holding the stocks. For example, you can invest in a company like Verizon, which has a dividend yield of 6.95%. So if you took $1,000 and invested it into Verizon stock, at the end of the year, you would earn around $70 in dividend payments. And companies usually pay dividends quarterly, although some companies do pay dividends regularly, but this would come out to around $17 per quarter. Now, this is not a huge sum of money, but it's a good start to investing and beginning to earn passive income, especially because most people right now are earning $0 in passive income, so something is better than nothing. And if you're ready to get started investing right now, then you can earn some free stocks through Webull when you sign up using my referral link in the description box below. The next strategy is to invest in index funds. And if you don't want to spend a whole bunch of time researching individual companies, then this is a great option for you. Index funds get their name because their objective is to match the returns of a specific market index. So an index fund may be trying to match the S&P 500, the Dow Jones Industrial, or the NASDAQ, and so on. One single index fund can diversify your money across hundreds and sometimes even thousands of different companies. And if you use a brokerage like Fidelity, then you can get started investing with just $1 since Fidelity index funds do not have an investment minimum. And if you're looking for more guidance on Fidelity index funds, I have a free downloadable guide to Fidelity index funds, which covers US equity, international equity, and bonds. And it also goes over how to create an investment portfolio. And this is 100% free, and you can download it using the link in the description box below. The next strategy is to invest in ETFs. And an ETF is very similar to an index fund, with one of the main differences being that you can trade an ETF on the stock market exchange during the day, just like you can with a regular stock, while index funds are only traded once a day after the market is closed. And there are different tax implications to keep in mind when choosing to invest in ETFs versus index funds. And I won't get into the details of that here today, but I do have another video where I talk about the differences and the similarities between mutual funds, index funds, and ETFs, and I cover tax implications there. So if you're interested in that, head over and watch that video after you're done watching this one. The next strategy is to invest using a robo-advisor. A robo-advisor is a digital automated platform that manages your investment portfolio for you. And because it's 100% automated, this means that you can be fully hands-off in the investment process, and it takes all the guesswork out of investing. And some examples of robo-advisors are Ellevest, which is specifically for women, but there's also Betterment and M1 Finance and a bunch more. The great thing about robo-advisors is that they tend to charge relatively low fees of around 0.25% to around 0.5%, while a human financial advisor could charge you anywhere from 1 to 2%. And this may not seem like a significant number, but in the investing world, fees add up very quickly, so you always want to make sure that you're choosing the lowest fees possible. And another great thing about robo-advisors is that they remove emotion from investing since they have a long-term horizon and they aren't super reactive to the market. Many people have a tendency to panic sell as soon as the market dips, and this is actually a very bad thing, and you could end up losing a whole bunch of money in the long run. With a robo-advisor, you don't have to worry about your emotions getting in the way of your long-term financial progress. One thing I want to note about robo-advisors is that they lack personalization. And we know that everybody's financial situation is different and personal investment preferences are different, but robo-advisors really don't care about that. So if you want more autonomy in and over your financial decisions, then this is definitely a factor you'll want to weigh in your decision of whether or not to choose a robo-advisor. Before we get into the next strategy, if you're enjoying this video so far, then please give it a thumbs up to boost it in the YouTube algorithm and subscribe to my channel for more weekly personal finance content. All right, the next strategy is to invest in treasury bills. Treasury bills are short-term securities that are backed by the US government, and they are called short-term because they have a maturity date of 1 year or less. And treasury bills are great because they are easily accessible to pretty much everyone because they have a minimum investment amount of only $100. You can purchase treasury bills from the treasurydirect.gov website, which is an official US government website. If you're especially risk averse, treasury bills are a great option because they are virtually risk-free. Treasury bills are backed by the US government, so that means you don't have to worry about losing your initial investment. But this is somewhat of a double-edged sword because since you are taking on less risk, that also means that your payoff in terms of interest you receive on your money is also going to be less compared to if you invested in different types of securities. You won't gain a whole ton of wealth through investing in treasury bills, but they are a great way to stabilize and diversify your portfolio. The next strategy is to pay off debt. Paying off debt is equivalent to investing in your future. Debt can be a very heavy burden that can weigh you down and hold you back from making progress financially. But I do want to note that not all debt is considered bad debt, but if you find yourself among the 46% of Americans who are in credit card debt, then you may want to prioritize paying this down as quickly as possible. Credit card debt is notorious for having high interest rates, which means your journey to debt freedom can take a little while longer because most of your payment is going toward interest and not toward reducing the actual principal. If you want to get serious about tackling your debt, then take a full inventory of all your debt and its interest rates, and then use a method like the debt snowball method or the debt avalanche method to start paying it down as quickly as possible. The next strategy is to invest in yourself. You can take that $1,000 and invest it in your education, in your hobby, or in your business. You and your future are worth the investment. And I'm a big believer that if you have a plan and you believe that this is what God has called you to do, then you should do everything that it takes to execute on that plan. Definitely do your research first, but then go ahead and sign up for that course, sign up for that class, start building that website or whatever it is that you need to do. Because the $1,000 that you invest in yourself right now could end up paying off exponentially in the future. Comment down below and let me know which one of these methods you're going to consider using to start investing $1,000 this year. And subscribe to my channel for more personal finance content just like this. Plus, if you're leaning more toward investing in index funds, then click the video on the screen for a step-by-step tutorial to investing in Fidelity index funds. Thank you for watching.